Look, we've had a very good year, as Tom said. EBITDA and net profit after tax, just over $1 billion and $560 odd million, both record numbers for the company, up a little bit on the prior year, and reflecting really the good coal prices that we had last year. I mean, from that, we did that safely as well, and that was a key thing. Our TRIFR rate, that's the lowest that we've ever recorded at the end of a financial period, so we're pretty chuffed with that result. Our equity ROM coal and sales coal were slightly up on the prior year, and we're just going through this hiatus period where we're still ramping up Maules Creek, but we lost Rockland at the end of the year before we go into our next growth phase, which I'll talk about in a moment. And we returned, or about to return, 30 cents a share, so $300 million coming back to shareholders. I think the stock trades X on about the 5th, so next week. And that takes our total dividend this year of 50 cents per share. I think that's about an 88% payout ratio, so well above our 20 to 50% guidance that we give. And we've always said that we'll return excess capital to shareholders while we don't have a need for it in the company. Our balance sheet is very strong. We've returned $1.1 billion to shareholders since November 2017, so in less than 2 years. And you think about that, that's probably double what it cost us to build Maules Creek, our equity share of that, and plus we obviously paid down the debt that we built to build that mine as well. So it's certainly been a good period for us. Now, the sort of questions that we're getting going around the traps the last week or two, a lot of uncertainty around the coal price, which is sitting sort of 63, 64 US a tonne for the Newcastle index at the moment. And the sort of issues that are impacting that, we've got the trade war between the US and China, obviously. There are these Chinese port restrictions on, particularly on importing Australian coal, and that is real. It's certainly occurring. We don't sell coal into China, so it doesn't impact us directly, but it's certainly impacting some of our competitors, and they're looking to find a home for the coal that they otherwise sell into China. There's also cheap gas, particularly in Europe, which is pushing coal out of the market in that jurisdiction, and we're seeing already some production cuts by coal producers in the US and also in Colombia. And at current prices, they can't get that coal into the Southeast Asian market, so they're being forced to cut back production, which I think in the long run is quite positive. We've got no new production come on stream, and you can see how difficult it is to get new projects up here, the pain that we're going through to get Vickery up. So, and all of our customers are still taking our coal. We're not having any trouble selling any of our coal at all. So demand for good quality coal that we produce is certainly there in the market. So I think we're probably near the low point at this stage. We get coming into the Northern Hemisphere winter, and we normally see that prices pick up through that period as demand starts to pick up. And then people were asking us about our growth, and we see ourselves as a growth mining company now. We've got certainly some greenfield projects in front of us, as well as expansion projects at a couple of our two big mines. So with Vickery, the Independent Planning Commission here is still reviewing the project. We expect an approval March, April of next year. This new IPC process, which the New South Wales government introduced about this time last year, in fact, we're one of the first companies into it. The whole process is probably just a waste of time, basically, we see. It's cost us 6 months, and they haven't added any value in the whole process. So the department is working through the issues that they raised, which are basically things that we pulled out in our environmental impact study anyway. They will deliver a paper to the IPC. There will be another public hearing, hopefully in this calendar year, and then the IPC goes away and determines the project. So we're expecting March, April. Now, we would also expect that we'll get challenged by some activist groups. We might take 6 months to get through that. So while we put some money in our guidance, some construction capex in our guidance for this year, there's a reasonable chance that that'll be pushed into the following year, given if there is an activist challenge to the approval. But we'll get through that. It'll only take 6 months or so, and then we'll be on. It's a 2-year construct, roughly $700 million spend. This project is quite robust. We're very comfortable about this. The other project, the Greenfield one we're developing, is our first go into Queensland with the Winchester South project that we purchased from Rio Tinto. And we have a pretty good record of buying things from Rio Tinto. Maules Creek came from Rio, Vickery came from Rio, and now Winchester South. We will announce our inaugural reserve on this probably with our AGM, so mid-October this year. And by contrast, the Queensland Government is very, very supportive of us getting this project up and approved. In fact, they're pushing us as opposed to us having to push them along the way. So we're well into the EIS study period, collecting all the data that's required for that, and you really can't quicken the pace of that. So we'd expect approval, final approval on sort of less than 2 years, a 2-year build again for this, roughly $800 million capex, excluding the yellow gear, and this will be a very, very robust project. This will be our highest margin mine by a long way, so even better than Maules Creek. So we're looking forward to bringing this thing into production. And then our other two sort of brownfield expansions at Maules, we're just about to go into in-pit dumping. That starts the second half of this year, and we're also have our first fleet of trucks, the automated system, running around from December of this year. So we'll gradually introduce that and take the overburden fleet to be completely autonomous in about 3 years' time. With that, with the improved productivity or utilisation that you get out of that equipment, effectively we can go to 16 million tonnes with the same overburden fleet that we currently have. So we're looking to seek an approval to lift the production from 13 to 16 million tonnes of that mine. As soon as we get the Vickery approval, we'll lodge the application for that. We don't want to get the two sort of mixed up at the moment. So within sort of 2 to 3 years, we'll be up at 16 million tonnes at Maules, and that'll be very low cost. The only other capital, there's a small amount of capital required for the preparation plant, but very little. And then we've got our longer term Narrabri Stage 3 project, which incorporates bringing the southern leases, the southern exploration licence that we have at Narrabri into the current mine plan. So we've commenced the work for that. And again, that's going to be a sort of 3 to 4 year piece of work. We need to start the development. In fact, we'll kick off some of the main road development required for that underground this year. We put some capex in the budget for it this year. So we finished the northern panels in FY24, and then we want to be ready to switch straight across to the southern side, and there'll be some significant cost reductions at that mine when we do that, because we're back in the shallow ground and in panels 8 kilometres long. So the longwall will be in one of those panels for 3 years, producing coal at probably around $50 a tonne, so significantly below the sort of mid-60s that we're doing it now. So that sort of shows our growth profile over the next few years. So flat at the moment, and then we go into this steep growth profile. And that's out to FY27. There's more, at that point, Winchester South's not ramped up to its full production, so there's more than that there coming.